Capital Advisors is a asset manager based in Tulsa, Oklahoma. We were founded in 1978, so we're 35 years old now. Manage about 1.3 billion in assets, and we have a range of different strategies that where we do our best to combine traditional fundamental analysis with quantitative disciplines for risk management.
We've heard a lot about clients being worried about risk and particularly about the taper. I understand you've got a strategy for that. Can you tell us about it and how it works?
Yeah, I wish I could say the strategy was specifically designed for the taper, but probably no such thing. But we've had a big run in the equity markets over the last 5 years, and in particular a great 12 months in 2013. And we're facing a change in monetary policy. The Fed wants us to believe that tapering isn't tightening, but I don't think the markets feel that way. So there is a shift coming. So lots of people, including ourselves, are worried about how do we keep the gains that we have, but stay in the game, so to speak. So moving averages and sort of exit strategies based upon following trends and crossing moving averages, that sort of thing. That's the strategy that you're referring to, called dynamic allocation. That's what it does. It slices up the risk markets into 5 pieces: domestic and international and emerging markets and natural resources and real estate. And anytime any of those 5 risk markets drops below a particular moving average, the strategy is designed to hit the eject button and get out. And so we're using it now as a complement to a core portfolio with our clients, so that at least part of their portfolio will react to trends if they turn negative in an objective way, and start reducing risk if these markets decide that enough is enough and start going down for a while.
So what are the markets telling you now? What are your indicators telling you?
Well, Dan, as you would guess, in a trend-following system like the one I'm describing, trends have been positive. So, of those 5 risk sectors that are in the portfolio, only one is not invested. Real estate is out of the portfolio because it remains kind of in a trading funk. So, it's about 90%, just under 90% invested in the risk markets and 10% out of the way. But again, anytime, if emerging markets continue with their underperformance, we'd expect those to come out probably next. Natural resources are close. International markets and U.S. markets look pretty healthy right now.
So this is an ETF strategy. It works. You work primarily or only with ETFs?
Only ETFs. You really couldn't do this strategy without them. You need the efficiency of limited trades to make big moves in broad sectors, and the tax efficiency as well. So it works great.
And how have clients responded to it?
They love it because they love to see their portfolio doing something when markets change. It feels good to at least take some action to reduce risk when the markets are in decline. And as much as we like to hold our clients' hands and tell them that your allocation makes sense and everything's going to be fine in the long run, we all know there's a certain set of our clients that just don't want to hear that. And so this is a great strategy to give them peace of mind, which helps. It helps them not make silly decisions at the wrong time.
So if other advisors want to know more about this or potentially work with you, what can they do? What's the best way to get more information?
Well, this particular strategy is described at a website called ctactical.com, letter C, tactical.com. And we're available on the Placemark platform, the LPL platform, as a separately managed account as well.
Well, thanks so much for taking the time, and good luck with the rest of the year.
Thanks, Dan. You too.